So what we're going to look at now is bit by bit, we're going to look at each different provision that we might find in a benefits plan, or each different type of coverage we might find in a benefits plan. We'll start with life insurance. It's an important provision. Most plans will include some life insurance of some sort. Usually when we see life insurance in a plan, it's either for a base amount, like $50,000 or $100,000, sometimes larger amounts, or sometimes a multiple of salary. So you might see 1 times or 2 times salary. And that's good, but we have to be cautious here. If you have a plan that has 2 times salary, you make $70,000 a year. 2 times 70,000 would be 140,000. What if your plan only has a non-evidence maximum of $100,000? Now you're going to have to get through underwriting to qualify for that extra $40,000 of insurance. A lot of people aren't even aware of that. They'll get a letter from the insurer telling them that they've gone over their non-evidence maximum, but I would suggest that most people don't really know what that letter means. Medical evidence then would be required. Now, if you do fail that medical, you're not going to lose the base amount of coverage. You're just not going to have the opportunity to get the larger amount of coverage. It's pretty normal, just because of the higher risk associated with older age, for group insurance plans to drop off at or around age 65. You will see some newer plans that have eliminated that provision. Sometimes we can have conversion of group insurance, but typically not after that stage, not so late in life. It is very normal for somebody to have conversion of their plan when they leave the plan or when the plan itself is terminated. In fact, most insurance acts require a 30-day conversion privilege for the life insurance portion of the plan only. So that means, without underwriting, I can leave my plan and take my life insurance with me. That's actually a very attractive feature, simply because if you have somebody who has a tough time getting insurance otherwise, maybe they've been declined for a traditional life insurance product, this gives them the opportunity to carry that coverage with them. It's not going to be cheap. It's certainly not going to be as cheap as buying your own individual underwritten life insurance policy. The insurance company essentially assumes that it's only fairly high-risk people who actually bother with that conversion privilege. You may or may not find a suicide exclusion clause with respect to this. It's not that common today, actually, although you will maybe encounter the occasional group that has suicide exclusion clause on their life insurance. When plans have life insurance, they almost always have dependent life added in. It's very inexpensive to add in a dependent life benefit. Essentially, this means we're going to have some life insurance on the spouse and children. It tends to be a fairly small amount. Usually the spouse for either $5,000 or $10,000, and the kids for $2,500 or $5,000 each. That coverage is typically not convertible into individual coverage, and it's often the only insurance that people carry on their kids. They may not even realize that they even have this benefit in place. A very common provision of group benefits plans is some accidental death and dismemberment coverage. It's so common, in fact, you'll run into association plans especially that have group accidental death and dismemberment coverage as their only benefit. It's where it's not in one of those standalone plans where it's included as part of a larger plan. It's often an amount mirroring the life insurance benefit. So you have a $100,000 life benefit. You might also have a $100,000 accidental death and dismemberment benefit. Accidental death and dismemberment coverage is very inexpensive. It's very inexpensive because in reality it's hard for it to pay. The problem with accidental death and dismemberment is, of course, the loss has to occur in an accident. And then beyond that, there are a large number of exclusions typically on AD&D coverage. So we have to be really careful with this coverage. It's fine coverage for the price you pay for it, but there are many losses that can occur. Cancer, for example, somebody killed driving while impaired. Those types of losses would not be covered. Now, I want to be careful with that driving while impaired exclusion. A lot of people jump to a conclusion there. That means that I get in a car, I've been drinking, I get in an accident, there would be no AD&D benefit paid to me if I get killed or if I lose limbs or use of limbs in that accident. But if I were to hurt somebody else and they had accidental death and dismemberment coverage and there was a valid claim, then it would pay. It's not the fact that somebody else was drinking that would hurt you there. Although there have been a number of court cases that talk about what about the person who gets in the car with somebody who's drinking and driving, and those cases have certainly gone both ways, where they've ruled against that person and in favor of that person. A relatively new innovation with group benefits is around critical illness insurance. And critical illness insurance we now see more and more frequently included, although still probably the majority of plans do not include a CI benefit. CI benefits usually for a relatively small amount, maybe $10,000 or $25,000. I have seen a few go up to $50,000 of critical illness coverage. I've even seen some plans with a small dependent CI benefit, maybe $2,500 or $5,000. It's a good coverage. It's not sometimes as robust as individual critical illness insurance. It might cover, say, 8 conditions or a dozen conditions. Well, you can certainly get critical illness insurance to only cover 4 or 5 conditions. Most critical illness insurance sold in Canada today would cover about 25 to 28 conditions. In reality, statistically, that's not that big a deal. Even the 4 basic conditions covered by critical illness insurance, that being stroke, heart attack, coronary artery bypass graft, and cancer, of course, that still covers about 95% of CI claims. So the difference between 15 conditions and 25 conditions is fairly negligible in a statistical sense, although probably very meaningful if you're somebody who actually develops one of those conditions. So with critical illness insurance then, we're going to have just this lump sum benefit paid, just as with an individual policy. This is something that sometimes can give an edge to somebody who's pricing out a benefits plan, include critical illness insurance in it. It's an attractive feature. Employers will look at it and say, you know, that's a nice little perk that my employees will have that they wouldn't have at other employers. Disability insurance is quite a complex area of group insurance plans. With group disability coverage, we're going to have coverage based on the risk for the group. We're going to have coverage that looks similar enough to individual disability insurance, but is different in some very meaningful ways. It's going to provide income replacement, just like an individual disability plan would, typically of 2/3 of income. It is going to pay a tax-free benefit as long as we've structured our premiums correctly. I did mention in the taxation section earlier that it's possible that premiums might be paid by the employer and passed on then as not passed on, as a taxable benefit to the employee. When that happens, then you might have an employer who chooses a larger amount of coverage, maybe goes all the way to 75%. Insurers will typically make that available if they know a plan is going to pay a taxable source of income to the employee. Now, when we look at income here, we're basing this on the income that the employer has entered into their data entry system that the insurer has them use. An employer who's been negligent in updating their employees' income is taking on the liability for that then, and there have been cases where employees have successfully sued their employers because the employer had failed to update the data with the insurer, and therefore when the employee became disabled, they were not receiving a sufficient disability benefit. The occupation definitions within disability insurance can be a little bit confusing. It is typically an own occupation benefit for 2 years, any occupation thereafter. The own occupation benefit in group disability insurance is pretty much identical to the regular occupation definition of disability in an individual plan. That is, in both cases, you'll receive a benefit as long as you are not gainfully employed in an occupation that looks somewhat similar to what you were doing before your disability. So under the own occupation benefit, really, if you can't go back to your job, you're going to collect benefits. But if you go back to a job that's quite similar, you're still going to end up losing your benefits just based on the fact that you're doing a job that falls within your kind of regular skill set. The any occupation definition is where you might have somebody who was, let's say, used to working as a sales rep, now goes to work in a call center. You're not going to find, under the any occupation definition, people forced to work in some job that's far beneath what they were used to previously. But certainly you'll find people doing jobs that they may not have chosen under that any occupation definition. And keep in mind that that's all based on a physician's determination that you're able to go back to work. So you may not want to go back to that job. That's not the consideration here. The consideration is, does a physician feel that you are well enough to go back to work? And there's much debate here about whether it's your physician or the insurance company's physician. Generally, the courts have said today that a physician of your choosing, as opposed to the insurer's choosing, is sufficient. And definitions, when you get into residual and partial benefits, for example, they can be quite a bit different than with individual products. So furthering on our discussion with disability coverage, I did mention earlier that we have exclusions here for pre-existing conditions. This tends to still be a fairly generous bit of coverage. What we're going to see is typically that where you have a pre-existing condition, it's only going to be a problem under most plans if it turns into a long-term disability in the first year or maybe 2 years of coverage. Usually we'll have no other meaningful exclusions, although typically you're not going to allow a claim for something like a healthy pregnancy, for example. And we have to be cautious here on the type of disability because human rights legislation, as we saw earlier, really prohibits discrimination based on the nature of a disability. There's at least one major insurer who actually offers conversion, like we saw with life insurance, of your disability coverage into an individual disability product. That can be quite attractive. It's pretty easy to become uninsurable or difficult to insure for disability purposes, so having this conversion privilege available can be quite useful. So to wrap up our discussion of disability coverage, we normally see waiting periods here that are fairly short, usually less than 2 weeks. Benefit periods, 5 years, 10 years, or out to age 65, depending on what the employer is willing to put in place, on how much cost they want to incur, really. Some plans have non-occupational coverage, meaning that we're going to let workers' comp take care of that person while they're working, and we're only going to put in place group insurance on a non-occupational basis. It's less expensive, but it does leave some risk, and you'll sometimes find with these plans kind of a gray area where workers' comp's not going to cover somebody and the group disability plan is not going to cover somebody. An example might be somebody who stays at their shop after work to do some work that may or may not be for the employer. The benefits plan says, well, you're at your site of your occupation, and workers' comp says, but you're not getting paid for it. You might find some gaps there. So that non-occupational coverage, it's something of a coverage of last resort. EI considers disability plans, group disability plans, to be first payer. That only applies to group disability, not individual disability. And as such, EI is not likely to pay for people who have short-term disability plans through their employer. You may then qualify for an EI premium reduction plan. That is, you can actually get your EI premiums reduced by what EI considers to be the appropriate amount of premium for that short-term disability offered by the employment insurance program. So most employees are actually going to be more aware of their extended health and dental coverage than any other portion of the plan, really because it's the one they're most likely to use. It's the one that they're going to put in claims on the most often. This is where we'd include paramedical services, that's a visit to a chiropractor, or a visit to a physiotherapist. This is a visit to, sometimes holistic medicine is covered in here. Counseling services of some sorts would be covered here. Your extended health, that's if you have a semi-private room in the hospital or ambulance ride to the hospital. Prescription drugs would be covered here. Your prescriptions when you go to the pharmacist within limits. We sometimes see, although less and less, vision care used in these plans. So we have a number of different plans that we can put in place here. In order to make health and dental plans affordable, to prevent the costs from spiraling out of control, because the fear that insurers have here is that employees take full advantage of plans and put in thousands and thousands of dollars worth of claims, driving up the cost of those plans, eventually making them unaffordable for employers and really shutting down the group benefits market. So in order to prevent that from happening, insurers put in place cost-sharing measures. They make sure that employees who are accessing these benefits are going to take into account, really, what am I using here? Do I want to use the group benefits plan? Is it worth my while? Is it going to cost me some money at the same time? So we want to make sure that when people are using the plan, they're using it because they need it. So how do we do that? Well, we put limits on the available services. So orthodontics are a great example of this. Lots of plans do not cover orthodontics or may only cover ortho for children. By limiting that orthodontic coverage, we're going to really pull out one of the most expensive discretionary medical or dental expenses that people might have in a year. We might have dollar maximums. We might put in place a limit. We might say no more than $1,400 worth of paramedical claims in a year, or something like that. Choose a dollar figure. That's really a plan design decision that the employer and the insurer or the agent will enter into. Might have service maximums where you could have no more than 6 chiropractic visits per year, or no more than 10 massage therapy sessions per year, or something like that. You might have a lifetime maximum. Again, orthodontics is a good example of this. If your plan does happen to include some ortho coverage, you might find that you cannot put in more than, say, $1,500 of ortho claims in a lifetime. There'll be a drug formulary. So in order to make sure that we're covering a known range of drugs, that we don't end up with some experimental treatment. And you'll find experimental drugs that can run $25,000 a treatment. You'll hear stories today about Remicade. It's a very commonly prescribed drug for rheumatoid arthritis, and it runs about $800 a treatment. So in order to make sure that we know what drugs we're covering, insurers will use a drug formulary. They will say these are the exact drugs that we cover and no others. We can have a fee guide put in place for dental services. This is something that typically the province's dental association comes up with to say this is what a cleaning should cost, this is what a filling should cost, this is what an x-ray should cost, and dentists are free to charge more than that, but typically insurers will not provide more coverage than what the fee guide suggests. This is actually a frequent source of frustration for plan members. It's very common to see dentists actually charge a higher amount than what the fee guide suggests. It's well within their rights to do so, but then what happens is plan members submit claims, and to their surprise, those claims do not end up getting covered. We can have co-insurance here as well. Co-insurance is really a cost sharing, a direct cost sharing, where the insurer might cover, let's say, 80% of the cost of a service, but the employee is left to cover 20%. It should, at least in theory, make the employee or the plan member think twice about any kind of service. They should say, well, I know I have to pay a few dollars out of pocket. Do I really need that service? It should bring us back to that area of medical necessity. And then deductibles, less frequently used, but still they're out there. Deductibles are essentially an amount that the plan member will have to pay before the insurer will pay anything. They are somewhat confusing and hard to administer, so some insurers have definitely gotten away from them, but you'll still find lots of plans that do feature some sort of deductible. So all of these cost-sharing measures really put in place just to limit the amount of claims that plan members put in, keep the costs in control, make sure that the employer is going to still be able to afford to pay for this plan the following year. One plan provision that's starting to gain some traction, it's been around for a good long time, but hasn't been used as much as it probably should have, is employee assistance programs, or sometimes you'll see these called employee and family assistance programs, and then there's a variation called the reverse employee assistance program. They're all roughly the same thing in that we're going to provide not really an insurance coverage here, but rather a preventative service. That is, we look at an employee, the employee's having some difficulty, maybe they're late for work a few days in a row, and the employer starts to ask some questions and finds out the employee's having some tough troubles at home, so they call up the employee assistance program for help. The employee assistance program might put them in touch with a local counseling service of some sort, and basically they might get 6 or 8 or 10 visits with that local counseling service paid for by the EAP. It's a confidential program. We're not going to tell the employer that the employee accessed whatever drug and alcohol counseling or whatever you have, but the employer will know that an employee accessed the service typically, although there has to be a fair bit of confidentiality here. It's an attractive service. It really is not insurance technically. It's more of a preventative measure. So we've looked here at the basics of group insurance. We've seen some of the contractual provisions and how the contracts are set up. We've looked at the different types of coverage available. There's still a lot left to understand about group insurance. It's useful to understand some of the concepts around how it's priced out, credibility and renewals. It's useful to understand funding models and some of the finer points of plan design. Those are all features that we'll address in a later presentation, but for now you should have a good fundamental understanding of group benefits. Thank you very much, and have a wonderful